Hi there, I'm Ben Jones. You're watching Dukascopy TV. Flash Manufacturing PMI for China was released in the early hours of the morning, and it still shows a contraction, dipping to the lowest level since July of last year. Joining me on the line to analyse this data and what it means for the Chinese economy is Qinwei Wang from Capital Economics. So Qinwei, the PMI data that came out earlier today showed a further contraction for China, dropping from 49.6 to 48.3. In your opinion, what has contributed to this, and what are the actual implications of this figure?
I think that due to the distortion of Chinese New Year's, monthly data are less accurate around this time of year. But HSBC market manufacturing PMI has weakened in both January and February, and it suggests that conditions in the sector has deteriorated. And it's also consistent with the view that the economy has continued to weaken. And I guess this basically the welcome result of the policymakers. They have some kind of major concern about the economy relying too much on the credit growth and the investment spending. And since the middle of last year, the People's Bank has tried to tighten the monetary conditions and to slow the credit growth to a more sustainable pace. And this is apparently has some impact on the investment spending and also the weight on the performance of the manufacturing sector.
So what can China do to stop this contraction? What's the correct way for the People's Bank of China to address this?
I think so far the major concern of the policymakers is still the credit risks. Basically, the credit growth has continued to be faster than the economy, and the strength of the economy has continued to rely on investment spending. So I don't think the People's Bank won't shift its monetary stance. So I think that it's more likely that People's Bank will continue to remain the monetary conditions relatively tight and to continue to slow credit growth. That will weigh on economy over the next few quarters. But I think this is positive for the outlook in the medium term.
Now, we've seen varying figures from China recently. Obviously, this disappointing PMI, but as a contrast to that, we saw improved trade balance data last week. One consistent figure has been the annual GDP growth rate, hovering between 7.5 and 7.9 for over a year. Looking ahead though, do you think that there will ever be a chance for China to reach double-digit annual GDP growth ever again?
I think it's need to be cautious to interpret the trade data because these theories have been very volatile, especially around this time of the year. And we think the strong figures, for example, in the export in January could largely due to some kind of the seasonal distortion rather than reflect a acceleration of the exports. So basically, we think the tight monetary conditions will continue to weigh on the growth in the months ahead. And at the same time, China's government seems to try to tighten oversight of the local government borrowing and many off-budget activities. So, which means that the fiscal activity will also be a drag of the economy. So, these factors suggest that the Chinese GDP growth will likely to slow in the next few quarters, but we think this slowdown is not too worrying because it will reduce the medium-term risks for China's economy.
Qinwei, thank you very much for talking to us. That's all from me, but stay tuned as Natalie MacDonald will be bringing you the Commodities Corner with a look at base metals. Goodbye.